You are one status was a dollar that wouldn't work for him for the next 30 years. And here's the psychological blow that destroys most people. You're not just competing with your needs, you're competing with your ego. Your ego wants you to look successful now, wants validation, the likes, the envy of others. But real wealth is invisible. It's built in silence. It's accumulated when nobody's watching. Munger used to say, showing off wealth is usually done by people who do not have real wealth. Now let's talk about the economic architecture that Munger mastered. There's a fundamental principle that completely separates rich from poor. The concept of capital working. Poor people work for money. Rich people make money work for them. Sounds obvious, but the implication is devastating. When you work for money, you trade time for income. Your earning capacity is limited by the hours you can sell. There are only 24 hours in a day. You sleep 8. Work 8 to 10. That leaves 6 hours to live, eat, family. Your income ceiling is fixed by the mathematics of time. But when money works for you, there's no ceiling. $100,000 invested at 10% per year generates 10,000. 1 million generates 100,000. 10 million generates 1 million per year without you lifting a finger. Same 24 hours, exponentially different results. Munger understood this viscerally. He calculated something brutal. If he continued as a lawyer, even as a partner, he might earn perhaps 500,000 to 1 million per year at his peak. Work 40 years. Retire with maybe 10 to 20 million if he invested well. Not bad, right? But if he took capital, invested in businesses with compound returns and reinvested profits, the numbers would be absurd. 50 million, 100 million, billions. Same intelligence, same effort, results 1,000 times different. The choice wasn't to work harder. It was to work differently. It was to position himself in the exponential game instead of the linear game. And here enters the genius of Munger's formula. He didn't create something complicated. He created something so simple it seems foolish. But simplicity is the ultimate sophistication. The formula has 3 parts. First, earn more than you spend. Second, invest the difference in assets that appreciate and generate returns. Third, never interrupt the process. That's it. Seriously, billions of dollars summarized in 3 lines. But let's break it down, because each part has layers most people don't see. Earning more than you spend doesn't just mean spending less. It means constantly increasing the distance between income and expenses. If you earn $3,000 and spend $2,800, you have $200 left. 7% margin. Pathetic. You never get anywhere. But if you earn $3,000 and live on $2,000, you have $1,000 left. 33% margin. Now you have ammunition. Now you have power. Munger lived on 20 to 30% of his income when he started. 70% went to investments. People thought he was crazy, insane, stingy. Meanwhile, he was building an unstoppable wealth machine. Second part, invest the difference in assets, not liabilities. Assets put money in your pocket. Liabilities take it out. Your car is a liability. Loses value every year, costs insurance, gas, maintenance. Your own home, technically, is a liability. Costs property tax, maintenance, generates no income. Dividend-paying stocks, asset. Rental property, asset. Business that operates without you, asset. Munger invested only in things that worked for him. And here's the secret. He focused on assets of exceptional quality. Not just any stock. Incredible companies with brutal competitive advantages that could be held forever. Third part, never interrupt. This means don't sell when the market drops. Don't cash out to buy a new car. Don't interrupt out of fear, greed, or impatience. Let compound interest do the magic. Einstein supposedly said compound interest is the 8th wonder of the world. Those who understand it, earn it. Those who don't, pay it. Munger lived this. He let investments grow for 50, 60 years, without touching them, without selling, just adding. The result? Billions. But there's a hidden component in the formula that nobody talks about. Munger called it circle of competence. He said, you have to figure out what you're good at and stay within that area. Don't try to be an expert in everything. Be exceptional at something specific and invest only where you truly understand. This goes against everything the market teaches you. Diversify, they say. Spread your money across 100 things. Munger and Buffett did the opposite. They placed big bets on few companies they understood deeply. Berkshire Hathaway has massive investments in few positions. Coca-Cola, Apple, Bank of America, American Express. Not 1,000 companies. 10 incredible companies. Concentration, not diversification. Why? Because when you truly understand something, when you've studied it deeply, when you're inside your circle of competence, the risk isn't concentrating. The risk is not concentrating enough. Diversification is protection against ignorance. If you don't know what you're doing, diversify. everyone else ignores. Ego makes you take idiotic risks, makes you double down on losing positions because admitting error hurts. Munger had zero ego in investments. If he was wrong, he sold and moved on. No attachment, no drama. Third, stupidity, impatience, wanting to get rich quick, jumping from strategy to strategy, selling early because you can't stand waiting. Wealth is built slowly. Many people prefer staying poor to getting rich slowly. They want the shortcut, the secret, the magic formula. It doesn't exist. There's time, discipline, and consistency. Fourth, stupidity, excessive leverage, using debt to amplify returns. Works wonderfully when everything rises, destroys you when it falls. Munger avoided debt like poison. He saw financial geniuses annihilated by leverage. Intelligence doesn't protect against bad leverage. Fifth, stupidity, following the crowd, doing what everyone's doing, buying when everyone's buying, selling when everyone's selling. Munger did the opposite. When the market was in panic, he bought. When it was euphoric, he waited. He said, "Be greedy when others are fearful, and fearful when others are greedy." Now, let's get into the part that really separates amateurs from masters. Munger wasn't just an investor. He was a systems thinker. He understood something profound. Wealth isn't about individual transactions. It's about building systems that produce wealth consistently. Let me explain the difference. Transactional thinking. I buy this stock, it goes up 10%. I sell, profit $1,000. Great. And tomorrow? You start from zero again. Have to find another opportunity, another trade, another profit. It's exhausting and limited. Systems thinking. I build a portfolio of exceptional companies that grow value consistently. I add capital regularly. Reinvest dividends automatically. The system works without my constant intervention. 20 years from now, the system has made me rich independent of any individual decision. See the difference? One is constant work. The other is initial design and minimal maintenance. Munger designed systems. He chose companies that had internal systems so strong they could almost not fail. Companies with network effects, with high switching costs, with pricing power, with exceptional management. He didn't bet on products. He bet on organizational systems that generated winning products consistently. Apple isn't valuable because of the iPhone. It's valuable because it has a system of innovation, design, marketing, and ecosystem that produces winners repeatedly. This understanding changes everything. You stop looking for the next hot product and start looking for anti-fragile systems. Let's talk about real numbers. Because theory without data is just philosophy. Charlie Munger started investing seriously in the early 1960s. He was about 40 years old. Let's be generous and say he started with $50,000 of investable capital. He wasn't rich, but had accumulated some capital from work as a lawyer. If he had put that $50,000 in an S&P 500 index fund and left it there for 60 years until his death in 2023, how much would he have? The S&P returned an average of about 10% per year in that period. $50,000 at 10% per year for 60 years results in approximately $20 million. Not bad. Comfortable life guaranteed. But he died with $2.6 billion. That's 130 times more. How? Two things: superior returns and continuous addition of capital. Munger didn't just get 10% per year. Through Berkshire Hathaway and his personal investments, he achieved returns close to 20% per year for decades. And he didn't stop at 50,000. He kept adding capital from his income as a lawyer, then as an investor, then from compound returns. Let's do conservative math. If he invested 50,000 initially and added only 10,000 per year for the first 20 years and achieved 19% annual compound return, how much would that be? Approximately $1 billion in 60 years. That without touching the money, without luxuries, just patience and discipline. The difference between 20 million and 1 billion is simply the difference between 10% and 19% per year. 9 percentage points. Seems small year by year, but compounded over decades, It's the difference between comfortable and obscenely wealthy. But here's what people don't grasp. How did Munger consistently achieve 19% when most get 7 to 10? 3 things. First, brutal selection. He rejected 99% of opportunities, waited for the perfect pitch. He said, investing is like baseball where there are no called strikes. You can wait for the perfect ball forever and only swing when you have absolute certainty. Second, infinite holding period. He didn't sell. When you buy a wonderful company at the right price and hold forever, you avoid capital gains taxes, avoid transaction fees, and capture full growth. Most investors churn portfolios constantly. Each trade generates taxes and fees that destroy compound returns. Third, psychological advantage. While others panicked and sold at the bottom, he bought. While others got euphoric and bought at the top, he waited. Absolute emotional control. This isn't luck. It's discipline forged over decades of psychological study. Munger read biography after biography of successful and disastrous people. He studied why some triumphed and others imploded. He internalized these lessons, transformed knowledge into behavior, and behavior repeated over decades generates extraordinary results. Let me give you a concrete example of Munger's mentality. In 1973-74, the American stock market fell 48%. It was brutal. Solid companies lost half their value. Widespread panic. People sold everything, swore never to invest again. Munger? He mortgaged his house and bought more stocks. Read that again. He put his house at risk to buy assets that were on liquidation. Is this crazy or is it genius? Depends on your frame of reference. For someone without knowledge, this is insanity. For someone who understood that great companies were being sold at ridiculous prices, it was the opportunity of a lifetime. He bought pieces of blue-chip stamps, See's Candies, and other companies at fractions of real value. These positions eventually became worth hundreds of millions, all because he had the psychological courage to act when fear paralyzed everyone else. That's the difference. Knowledge without courage is useless. Courage without knowledge is suicide. But knowledge combined with courage? That creates billionaires. Let's talk about something Munger called mental models. He believed you need a lattice of models from multiple disciplines to think clearly. Not just finance, physics, biology, psychology, history, mathematics, engineering. Each field offers models that help you understand reality better. Example, the concept of breaking point from physics. Materials withstand stress to a point, then break catastrophically. This applies to companies. They handle debt to a point, then collapse. Applying models from other areas to investments gives you advantages that purely financial specialists don't have. Another example, evolution from biology. Companies that adapt survive. Rigid companies die. Competitive advantage is like evolutionary traits. Some give massive advantages, others are irrelevant. Munger used dozens of these models simultaneously to evaluate investments. He looked at a company and instinctively checked, does this have network effects? Does it have economies of scale? Does it have switching costs? Does it have pricing power? Is it in a structurally attractive industry? Management aligned with shareholders? This multidisciplinary analysis allowed him to see value where others saw only numbers, and this created margin of safety. Another Munger concept. Margin of safety means buying something for much less than it's worth. If it's worth 100, you buy for 50. So even if you're partially wrong in valuation, you still profit. Without margin of safety, you need to be right all the time. Impossible. With margin of safety, you can be half right and still win. There's a story that perfectly illustrates Munger's mentality. In the late 1960s, he and Buffett bought a stake in See's Candies for $25 million. At the time, it seemed expensive. The company had tangible assets of only $8 million, but it had something special: powerful brand, loyal customers, pricing power. People paid more for See's chocolates because they associated the brand with quality and special occasions. Munger convinced Buffett to pay 3 times book value because of these intangibles. It was controversial. Many analysts called it madness. But look what happened. Seas generated over $2 billion in profits for Berkshire in the following decades. $2 billion from a $25 million purchase, 80 times return. And they still own the company. Why? Because strong brand with pricing power is an almost perpetual money machine. While competitors competed on price and margins disappeared, Seas raised prices 2–3% per year consistently. Customers paid happily. This purchase completely changed the investment philosophy of Munger and Buffett. They stopped looking for cheap, mediocre companies and started looking for excellent companies at fair prices. The difference? Mediocre, cheap companies remain mediocre. Excellent companies at fair prices become more valuable every year. One you sell quickly with small profit, the other you hold forever and generate generational wealth. But let me be brutally honest about something. Munger's formula works, but requires sacrifice most aren't willing to make. You need to live below your means for years, maybe decades. While friends buy big houses, you rent small. While colleagues change cars every year, you drive the same one for 10. While relatives take expensive vacations, you stay home and invest. Socially, you'll seem strange, stingy, out of tune. People will judge, will question, will say you're wasting your life. And here's the hard part. They're partially right. You are giving up present pleasure for future security. You're trading social status for silent wealth. You're betting that having financial freedom at 50 is worth more than impressing people at 30. This isn't an easy choice, and it's not the right choice for everyone. Some people prefer to live well now and deal with consequences later. Munger made the opposite choice. He lived modestly for decades, and in the last 30 years of life had absolute freedom. Could do what he wanted, when he wanted, with whom he wanted. No boss, no financial worries, no unwanted commitments. Was it worth it? For him, absolutely. For you? Only you can decide. Here's something that will sound harsh but needs to be said. Munger had little sympathy for people who complained about circumstances but didn't change behavior. He said, "Show me the incentives, and I'll show you the outcome. If you keep staying poor despite earning decent income, it's because your incentives are wrong. You incentivize consumption, not accumulation. You reward status, not patience. You prioritize appearance over substance. And until you restructure your personal incentives, nothing changes. You can read 1,000 books about finance, can watch 1,000 videos, can know all the strategies, but if your personal incentives reward spending, you'll spend." Munger structured his entire life around the incentive to accumulate. He measured success not by salary or possessions, but by how much capital was working for him. Every invested dollar was a soldier in his army, and he wanted the largest possible army. This mental framework changes daily decisions. Buy a $5 coffee? It's not just $5, it's $5 that could become $80 in 30 years. Buy a $50,000 car? It's not just $50,000, it's $500,000 in 30 years. Suddenly, every spending decision has massive opportunity cost. And you start asking, is this really worth what I'm giving up in the future? Most of the time, the answer is no. Let's address the obvious objection. You might be thinking, this worked for Munger because he lived in a different era. Market was easier. Opportunities were bigger. Today, it's impossible. Wrong. Completely wrong. The market today offers opportunities Munger never had. You can buy pieces of the world's best companies with a few clicks. No broker. No absurd fees. With pennies. Munger needed substantial capital and connections to access deals. You have instant access. He needed an entire library to research companies. You have all information on the internet for free. He needed to wait days to execute trades. You execute in seconds. The tools today are infinitely better. What hasn't changed? Human psychology, greed, fear, impatience, envy. These forces still dominate markets. And as long as they dominate, disciplined people with knowledge will have an advantage. Munger's formula didn't depend on a specific era. It depended on timeless principles. Spend less than you earn. Invest the difference. Let compounding do the magic. Avoid stupidity. These principles worked in 1960. They work today. They'll work in 2060. So what do you do now? First, accept that you're starting a decades-long journey. Not months, not years, decades. If this timeline scares you, you've already lost. Real wealth requires time. There's no shortcut. Second, calculate your current savings rate. Income minus expenses divided by income. If it's below 20%, you have a problem. Increase to 30, 40, 50% if possible. Third, open an investment account. Choose a simple brokerage with low fees. Start depositing any amount regularly. $100 per month, $200, $1,000. Initial amount matters less than consistency. Fourth, buy quality assets. If you don't know how to pick individual companies, buy broad market index funds. S&P 500, total stock market. Boring, but effective. Fifth, never sell. No matter what happens. Market drops 30%, buy more. Market rises 50%, hold. Your only action is buy and hold. Sixth, reinvest all dividends automatically. Never spend them. Each dividend buys more shares that generate more dividends. Positive spiral. Seventh, increase contributions as income increases. Got a 10% raise? Increase investment by 10%. Don't increase lifestyle. Eighth, educate yourself constantly. Read about companies, economics, psychology. Munger read 6 hours a day. Can you manage 1 hour? Ninth, ignore noise. Media will scream about crashes, bubbles, crises. Ignore it. Your horizon is decades. Short-term volatility is irrelevant. 10th, be patient. Absurdly patient. In the first 10 years, you'll see little progress. It's normal. Compounding starts slow. But after 20, 30 years, explosive. Charlie Munger died without leaving a self-help book. No online course, no promises of quick riches. He left something better. Decades of wisdom documented in interviews, letters, and speeches. And the message is always the same. It's not complicated. It's hard. There's a difference. Complicated means confusing, impossible to understand. Hard means simple to understand, but requires discipline to execute. Munger's formula is hard, not complicated. Anyone can understand it. Very few will execute. Because execution requires sacrificing today for tomorrow, requires going against social instincts, requires ignoring others' opinions, requires unwavering conviction when everything seems to be crumbling. Can you do it? Honestly, most can't, and that's why most stay poor. Not from lack of opportunity, not from lack of information, from lack of character and discipline. Does this sound harsh? Good. It should. Because while you seek comfort and validation, there are people applying this formula silently. In 10 years, they'll be comfortable. In 20, wealthy. In 30, incredibly wealthy. The choice is yours. Read this and act, or ignore it and stay exactly where you are. Charlie Munger showed the path. Walking it is up to you. If this opened your eyes, share it with someone who needs to hear it. Subscribe to this channel because we don't sell dreams here. We deliver the brutal truth about wealth. See you in the next one. Charlie Munger left us with an undeniable truth. Overwhelming success is not a mathematical equation. It is an exercise in applied psychology. You can have the initial $50,000 and the $10,000 annual plan. You can know the power of a 19% return. But without Munger's mental framework, you will sell in a panic buy in euphoria, and worst of all, squander the power of time with small, constant financial stupidities. Your biggest challenge is not the market. Your greatest obstacle is not the S&P 500. It's not the interest rate, nor the next CEO of that amazing company. Your greatest obstacle is the mirror. It is the fear of looking foolish while you quietly accumulate. It is the pressure to spend when your wealth system demands you accumulate. It is the temptation to act when Munger's philosophy dictates to wait. The difference between a comfortable life of $20 million and the obscene freedom of $1 billion is not how clever you are at picking a stock. It is how disciplined you are at doing nothing when discipline is hardest. It is how well you control your own emotions and incentives. That is the game. Munger looked at a 48% market crash and saw liquidation and the opportunity to mortgage his house. Most people look at the same scenario and see the end of the world and the incentive to flee. The information is available to everyone. The capacity to act under stress, contrary to the herd, is what remains the rarest and most valuable asset on the planet. And this capacity is forged, not ready-made. It is built brick by brick through the study and application of mental models. The final verdict and your next step. So, the remaining question is not whether you understood Munger's path, but whether you have the moral fiber to walk it. The path is simple. Design a system. Do not rely on transactions. Fuel the system with a high savings rate. Let the system work with the patience of decades. Protect the system by avoiding stupidity and panic. You have the map. What will you do with it? Will you read this and 5 minutes later buy a $5 coffee, squandering a future of $80? Or will you close this tab and immediately start step number 2, increasing your savings rate? The choice you make now will define your financial destiny. If you are tired of empty promises and are ready to absorb the practical brutality of the great thinkers of Wall Street and apply system design to your own financial life, you are in the right place. Here at Chroma Dynamics, we don't sell dreams. We deliver the brutal truth about how money actually works. Click the subscribe button now to continue dismantling the myths of wealth and build your own financial freedom with the same depth of thought that made Charlie Munger a billionaire. We will give you the lenses. The job of seeing and acting is yours. See you in the next one.